February 5th, 2026. Shanghai Futures Exchange drops official announcement number 37. 6 groups of linked accounts caught red-handed, exceeding intraday position opening limits on silver contracts. Restricted position opening measures imposed immediately. This isn't speculation. This isn't theory. This is documented regulatory intervention confirming what the data has been screaming for weeks. 674 million ounces of paper silver dumped in a single morning session. That's not a trade. That's a coordinated assault. And the exchange just confirmed it officially. While you were watching headlines about stock market corrections and crypto volatility, something far more significant happened in the vault systems that underpin the entire precious metals market. In 24 hours, 15% of available silver inventory vanished from Shanghai Futures Exchange warehouses. Not sold, not traded, physically removed, gone. Let me give you the current battlefield numbers as they stand right now. Silver Western spot price sitting at $74 per ounce. Shanghai spot at $80. Shanghai futures trading at $99. That's an $8 premium in Shanghai over Western prices. When you see geographic price dislocations of that magnitude, you're witnessing the early fractures of a unified global pricing system. But the premium is just the surface. The real story is in what's disappearing from the vaults while everyone watches the price ticker. COMEX just reported 3 million ounces pulled from registered inventory in one day. Normally, futures contracts settle physically at a rate of 1 to 3% at most. Right now, 100% physical settlement. Read that again. Every single contract that could take delivery is taking delivery. This isn't a futures market anymore. This is a scramble for physical metal disguised as normal market operation. Total COMEX inventory has now dropped to 400 million ounces. Shanghai Futures Exchange vaults are down to 350 tons, approximately 11.25 million ounces. That 15% daily drain isn't an anomaly, it's acceleration. And here's where it gets truly dangerous. COMEX registered silver, the metal actually available for delivery against contracts, sits at 103.3 million ounces. Total open interest across all contract months, 688.5 million ounces. The math is simple and terrifying. There are paper claims for nearly 7 times more silver than actually exists in deliverable form. This isn't a potential problem. This is a structural impossibility waiting to detonate. Now, let me tell you about the third margin hike in 10 days. Because this is where you see the fear in the system made visible. CME Group just announced another increase in margin requirements going into effect after the close on Friday, February 6th. Maintenance margin for gold futures up 11%, for silver futures up 20%. Silver margins have now been hiked to 18% from 15% in the span of a week. Let that sink in. They're raising margin requirements while prices are falling. Under normal market theory, you raise margins when volatility and prices surge to protect against outsized moves. But we're seeing margin hikes during price suppression. Why? Because the exchange knows something the public doesn't yet understand. They're seeing the position concentrations. They're seeing the physical drain rates. They're seeing how many traders are on the wrong side of what's coming. The average true range on silver futures currently sits at a record 14.17 per ounce, representing 19.3% daily volatility. Yes, the margin hike brings requirements in line with that volatility mathematically. But exchanges don't raise margins out of comfort. They raise them out of fear. If gold were the systemic risk, gold would be hit harder with margin increases. It isn't. Silver is. High margins equal stress in the system. Stress equals positioning risk. Positioning risk equals too many participants on the wrong side of a trade that could break the clearinghouse. You can hike margins on paper contracts all day long. You can force liquidations. You can shake out weak hands. But you cannot margin call physical scarcity. And that's what the system is facing right now. Here's the historical pattern you need to understand, because this has happened 3 times before in recorded economic history, and the outcome is always identical. The Roman Empire in the 3rd century didn't fall to barbarians first. It fell to monetary debasement. Emperor after emperor clipping coins, reducing silver content, expanding the money supply to fund endless wars and pacify the population. By the time of Diocletian, the denarius had gone from 95% silver to less than 5%. Prices exploded. The legions mutinied over worthless pay. Trade collapsed. The empire fragmented, verified. The Dutch Empire in the 17th century controlled global trade through the Dutch East India Company and the Amsterdam Bourse, the world's first true stock exchange. They were the reserve currency of their age. Then came the wars with England and France. Massive debt accumulation to fund military operations. Theftful inflation. The wealth transfer began. By the early 18th century, Dutch financial dominance had evaporated, transferred to London. Same pattern, same sequence, same outcome. Check. The British Empire in the 20th century issued the currency that settled global trade. Pound sterling was the world's reserve. Then came 2 world wars. massive debt accumulation, the 1931 abandonment of the gold standard, the 1944 Bretton Woods Agreement that subordinated the pound to the dollar. By 1971, even the dollar's gold peg was severed. The wealth transfer was complete. Britain went from empire to managed decline in a single generation. Not opinion, pattern recognition. Debasement, war, debt, loss of reserve status, collapse. This isn't a theory about cycles. This is documented historical sequence that has destroyed every single empire that followed this path. And right now, the United States is in the final stages of that exact same progression. The national debt just crossed $36 trillion. That's $36,000. Annual interest payments on that debt now exceed $1 trillion per year, more than the entire defense budget. The debt to GDP ratio is approaching 130%, levels historically associated with sovereign crises. But the numbers alone don't tell you what stage we're in. The pattern does. In 2008, the Federal Reserve's balance sheet was under $1 trillion. By 2020, it had ballooned to $7 trillion. Today, it sits above $8 trillion, despite so-called quantitative tightening. That's currency debasement in modern form. Not clipping coins, but expanding base money supply by 800% in 15 years. The wars? 20 years in Afghanistan, Iraq, Syria, Libya, Yemen, proxy conflicts in Ukraine, rising tensions with China over Taiwan. The global military presence hasn't contracted. It's metastasized into permanent operational tempo that bleeds the treasury dry. The debt? Compounding exponentially with no political will or mathematical ability to ever pay it down. And the reserve status? BRICS nations, now representing 45% of global population, are actively building trade mechanisms that bypass the dollar. The petrochemical agreements that enforced dollar hegemony since the 1970s are being renegotiated. Saudi Arabia now accepts yuan for oil. The foundation is cracking. We are not approaching the cliff. We are not at the edge of the cliff. We have already walked off it. The ground just hasn't disappeared beneath our feet yet because of monetary and perception lag. But the mathematics are already in motion, and mathematics don't care about narrative or hope. Now, let me tell you what yesterday's forced crash in the silver market actually accomplished, because this is where you see the desperation. COMEX total futures, open interest, dropped by approximately 6,000 contracts in one day, likely all linked to tokenized silver products tied to the March 26th contract. Total open interest fell to roughly 137,700 contracts. On the surface, that looks like longs capitulating, speculators getting shaken out. But look deeper. The open interest that remains isn't speculative. It's positional. These aren't traders looking to flip contracts for profit. These are entities waiting for delivery. The ratio of open interest to registered available silver is now completely inverted from anything resembling a functional market. March 2026 contract open interest sits around 429 million ounces in paper claims. Registered silver available for delivery, 103 million ounces, and falling daily at a rate of approximately 785,000 ounces. By the time March delivery period begins on February 27th, just 3 weeks from now, registered inventory could fall to 85 million ounces. Now run the scenarios. If 25% of open interest stands for delivery, that's 107 million ounces demanded against 85 million available. Shortfall of 22 million ounces. If 50% demands delivery, that's 214 million ounces against 85 million. Shortfall of 129 million ounces. If we see the 100% physical settlement rates that have characterized the last few days continue into March, that's 429 million ounces demanded against 85 million available. Shortfall of 344 million ounces. There are only three possible outcomes when the math doesn't add up like this. One, they find a massive new source of physical silver and inject it into registered inventory in the next 3 weeks. Where is that silver going to come from? Eligible inventory exists, but those holders aren't converting to registered at these suppressed prices. They're holding for higher because they understand the shortage. Two, they force price so low through paper manipulation that demand destruction occurs and contracts get rolled or liquidated instead of settled. But that strategy has a terminal problem. These artificially low prices accelerate physical drain because buyers at the ground level load up when prices drop. You saw it in Singapore, where retail investors queued outside United Overseas Bank to buy physical gold even as prices fell. You saw it in Australia, Thailand, and China with the same pattern. Physical buyers don't trade charts. They buy weight. Lower prices mean more ounces per dollar. The suppression strategy is feeding the very shortage it's trying to manage. 3. Force majeure. Cash settlement imposed. Contracts settled at paper price instead of physical delivery. This is the nuclear option that shatters confidence in the entire price discovery mechanism. If COMEX defaults on physical delivery obligations, the paper price becomes irrelevant. Physical silver trades at whatever premium the market will bear, and the 150-year-old commodities exchange system loses all credibility. The entity that dumped 674 million ounces of paper silver in one morning session wasn't trying to make money on that trade. You don't make money crashing a market that violently. You're either closing a position you're forced out of, or you're trying to break the market itself before it breaks you. Billionaire Bian Cheng built the largest net short position in silver on record. Shanghai Futures Exchange just banned his linked accounts. Think about what that means. A billionaire with unlimited capital couldn't sustain the short position. The exchange had to step in and shut it down. When even the largest players with the deepest pockets can't hold the line, that tells you the physical reality is overwhelming the paper machinery. Now, let's talk about what this looks like when it breaks, because collapse isn't abstract, it's visceral. Imagine you walk to an ATM to pull out cash. The screen says your account balance is intact, but the machine says it can't dispense currency due to system limitations. You go to another bank. Same message. You try to use your credit card at the grocery store. Transaction declined due to processing issues. You check your brokerage account. It shows your portfolio value, but you can't place trades. The system is under maintenance. You try to wire money, 3-day hold for verification. These aren't hypothetical scenarios from a movie. This is exactly what happened in Cyprus in 2013 during the banking crisis. ATMs were limited to 100 euros per day. Bank accounts over 100,000 euros were seized to recapitalize the banks. People who thought their wealth was secure in the banking system learned that in a crisis, your deposits are actually unsecured loans to the bank, and the bank gets to decide if and when you get them back. In a currency crisis or sovereign debt collapse, this pattern happens fast. Faster than the news cycle can report it. Faster than people can react. You wake up and the prices of food, fuel, and basic goods have doubled overnight. Not because of supply problems, but because the currency lost half its purchasing power while you slept. The Weimar Republic in 1923 saw people paid twice a day because money lost value by the hour. Zimbabwe in 2008 printed $100 trillion notes that couldn't buy a loaf of bread. Venezuela right now has people using cash by weight because the denominations are meaningless. These aren't ancient history or distant places. This is the documented end stage of the debt debasement war cycle. And right now, yesterday, you saw every major market sell off simultaneously. Cryptocurrencies down, stocks down, bonds down, precious metals down. When everything correlates to the downside at the same time, that's not individual market weakness. That's systemic deleveraging. That's forced liquidation across asset classes to meet margin calls and redemption demands. Bitcoin, which had been leading risk appetite, is down 46% from its peak. Amazon stock fell 15% in a single day after earnings. Hedge funds are dumping U.S. equities at the fastest pace since October, selling single stocks aggressively, both covering shorts and liquidating longs. 5 of 11 sectors experienced net outflows led by information technology, industrials, and materials. This isn't rotation. This is exit. The S&P 500 volatility index spiked to levels not seen in 2 months. The U.S. Embassy issued warnings for American citizens to leave Iran immediately. Geopolitical tensions escalating, nuclear concerns rising, risk-off accelerating. And in the middle of all this chaos, silver vaults are draining at 15% per day. Let me say that again, because it's the most important data point in this entire situation. In the middle of a massive risk-off liquidation event where everything is selling, physical silver is leaving the system. Price down, inventory down. That is not bearish. That is physical disconnecting from paper. SLV, the largest silver-backed ETF, traded $41 billion in volume on Friday. That's more trading volume than any single stock in the entire world that day. $41 billion in a single silver ETF. That level of volume represents violent position changes, forced liquidations, and capitulation. But look at what happened to physical inventory during that same period. It didn't flood back into the market. It accelerated out of the market. When paper dumps and physical disappears, you're watching 2 different markets operate under 2 different rules. Paper can be created infinitely. Physical is finite. And right now, the finite is winning. Let me give you perspective on technicals because sentiment is everything in market timing. The last time silver traded near $65 per ounce was mid-December 2025. At that time, the 14-day RSI was pushing 80, indicating extreme overbought conditions. Sentiment was euphoric. Everyone was talking about silver going to $100, $200, infinity. Today, silver is at the same $65 price level, but the RSI sits around 30, indicating oversold conditions. Same price, opposite sentiment. In December at $65, people were buying out of greed. Today at $65, people are selling out of fear. This doesn't mean the bottom is in right now, this moment. Markets can remain irrational and oversold longer than you can remain solvent if you're leveraged. But it does mean the risk-reward has inverted. The entity that crashed silver 47% in 7 trading sessions moved with urgency and desperation. When moves happen that fast in either direction, reversals can be equally violent. But timing that reversal requires confirmation, not assumption. Gold's parabolic trajectory has not been broken, which provides context that the precious metals bull market structurally remains intact. But silver's individual price action still needs to stabilize and show reversal signals before calling any bottom. The risks are real and need to be stated clearly. CME margin hikes are forcing continued liquidations. Third increase in 10 days with silver hit hardest. Bitcoin is leading the risk-off move, and the silver-gold ratio is tracking Bitcoin directionally. As long as Bitcoin remains under pressure, downside risk in silver persists. Bitcoin is the canary in the coal mine for this deleveraging wave. Crypto market cap is down $350 billion in one day, $2.4 trillion, combined with metals at the lows. Hedge funds dumping equities at the fastest pace in months. Geopolitical tensions rising with Iran. Everything is correlated to the downside. When everything sells together, it's systemic stress, not fundamental weakness in individual assets. But here's the structural tension that will not resolve peacefully. Shanghai Futures Exchange has officially confirmed coordinated short attack, banned 6 account groups, documented regulatory intervention, COMEX registered inventory down to 103 million ounces. Open interest, 429 million ounces. March delivery starting in 3 weeks. Shanghai vaults down to 350 tons with 15% drained in one day. 100% physical settlement on COMEX versus normal 1 to 3%. Singaporeans queuing for physical gold despite falling prices. Physical demand is not collapsing. Physical demand is accelerating into weakness. The fundamentals of physical shortage have not changed. What's changed is the paper price. And the paper price is being overwhelmed by physical reality. Total COMEX silver deliveries in 2025 hit 474.4 million ounces, more than double the 202.7 million delivered in 2024. Every single month showed higher deliveries year over year. This wasn't a fluke or single-month anomaly. Participants are ditching rollovers and demanding physical metal instead. January 2026, normally a quiet off month for silver deliveries, exploded to 49.4 million ounces delivered, up massively from prior years. People are front-running March because they're worried about getting metal later. When minor months turn major, that signals real fear in the system. February 2026, just the first few days, has already seen nearly 19 million ounces delivered, almost matching all of last February's total. Almost 100% of open interest in February stood for delivery, way beyond the normal 5 to 20% rate. This isn't a futures market anymore. It's turning into a physical grab. March 2026 is the big one looming. If even 25% of open interest demands delivery, that's over 100 million ounces needed. At 50% delivery rate, 214 million ounces. At 70%, up to 300 million ounces. Last year's March was already stressed at 80 million ounces delivered. Registered silver has dropped from 167 million in October 2025 to around 103 million now. That's a 38% plunge in 4 months, and the drain is accelerating. At current drain rates of 785,000 ounces per day, by the start of March, registered could fall to approximately 85 million ounces, far short of potential demand. Eligible silver exists in COMEX vaults, around 297 million ounces, but those owners aren't converting to registered at these prices. They're holding for higher. They understand the shortage. Even if March matches last year's 80 million ounce delivery, that leaves virtually nothing for May, July, and September contracts, which are also showing rising open interest. If the drain continues, later months face the same squeeze. The shortfall could force cash settlements, force majeure, or shatter confidence in the paper pricing system entirely. The math does not add up. The paper empire of silver is crumbling under the weight of physical reality. This is not might happen. This will happen. The only question is timing and catalyst. Does March delivery break COMEX with 429 million open interest against 103 million registered and accelerating drain? Or do margin hikes and Bitcoin-led risk-off force more liquidation before the physical shortage overwhelms paper suppression? Shanghai Exchange is already cracking down on coordinated shorts. Shanghai vaults losing 15% in a single day. Singaporeans queuing despite price drops. The system is showing cracks, both regulatory and physical. 3 weeks until March 1st delivery notice. You cannot unsee this pattern once you understand it. Debasement, war, debt, loss of reserve status, collapse, Rome, Amsterdam, London, now Washington. Same pattern, same sequence, same outcome. The smart money isn't buying the dip in stocks. The smart money is leaving the system entirely and moving into hard assets that can't be printed, debased, or inflated away. Gold, silver, land, productive farmland, energy resources. Physical assets with intrinsic value that have survived every currency collapse in history. This is not a crash. This is a wealth transfer. Wealth is not being destroyed. It's changing hands from those who trust paper to those who hold physical, from those who believe in the system to those who prepare for what comes after the system. The vault drains are telling you everything you need to know. While prices fall, metal disappears. That's not bearish. That's the end game. Paper can suppress price temporarily. Physical removes supply permanently. And when the paper market breaks, when COMEX can't deliver, when Shanghai vaults are empty, the price discovery mechanism shifts from the exchanges to the streets. And on the streets, physical silver will trade at whatever premium desperate buyers will pay. The empire is falling, not in some distant future. Right now. The mathematics are already in motion. The debt can't be paid. The currency can't hold value. The vaults are draining. The exchanges are cracking. The billionaires are being banned. The system is defending itself with margin hikes and paper dumps, but you can't margin call scarcity. Mathematical certainty. 3 weeks to March delivery. 103 million ounces registered. 429 million ounces in claims. The collision is coming. Position accordingly.